Hello, everyone. Thanks for tuning in. This is going to be the second episode of my sort of qualitative talk through series, Fixed Income Meandering. Today, I would like to discuss a topic which can get controversial at times, but I feel like it's essential to understand the repo markets and plumbing around fixed income, which is the intersection of politics and repo. And it's gonna be polemical because I'm giving my opinion and qualitative analysis, but I'm gonna try to stay away from just like partisan politics and just being offensive to be offensive. And I'm going to try to talk about my opinions on the structure. So, first of all, like to dive into this subject properly, I have to kind of explain my view on fixed income and macroeconomics and explain how I view where repo emerges. So, I I'm not a denier of free markets. I very much believe that there's free markets, there's liquidity, and that's on top of it. But I also I like reading some other economists which actually make a point that even in a totally free market system, there is a sort of implied central planning to everything. And this isn't conspiratorial. This isn't even force. It's just simply put, when there's centralized exchanges, when there's centralization of liquidity, you essentially get a form of central planning, even if that wasn't necessarily the system itself. And it pretty much shows, if you look at any civilization as it adapts, there is a case to be made that there is a form of central planning within every major society. And that's kind of what happens. And the argument then becomes less of what system is being used, and it's more of how efficient is the system being used, what are the resource allocations, and what's the general goals. And in my opinion, the within finance, securities finance, fixed income, the sort of class that describes the plumbing and mechanisms of how a society is planned and centrally run is the repo markets. I actually, if I can find the links, I'll leave them in the description. I apologize if I can't, but I've read some really good economists from the Cold War period, and they bring up a interesting example that even in societies that prohibit some aspects of free trade, you see implied debt, implied repo markets. And you can actually model the same sort of liquidity, credit stress, government solvency that happen within the United States, within Western capitalism, also occurs internationally. And to some extent, it can actually be felt worse. I know there's heavy critique of centralized finance, central banks, and repo, but I think an argument to be had for why these systems are important is in societies where it's more restrictive, there's less free trade, or it's outright outlawed. You actually see what would be felt as a repo shock within the United States would be directly transmitted into commodities, into labor, into supply chains. It happens in America. There's definitely a transition, there's a transmission of repo shocks to the whole economy, but it can be modeled as worse without having that kind of intermediary layer. Now, why I'm bringing this up is I think one of the most fascinating civilizational shifts in my lifetime within the United States was the transition from the Eurodollar repo system to the secured overnight or SOFR system. And I'm going to give a economic student overview of this. This is in no no chance meant to be a professional, a central bank level analysis, but this is kind of just a quick overview for if there's any other students watching less in tune with the subject. But basically, up until the money market fund rules were changed around 2016, up until there were some other behind the scenes legislation and nuanced rules, the repo on the dollar wasn't necessarily just the wasn't necessarily just tied to treasury bills and their overnight collateral. You actually saw before this a system called Eurodollar, which wasn't just one thing. It was a decentralized form of repo, but you saw ties to international bank deposits and using that as liquidity and leverage. You saw more commercial paper, more private you saw more corporate lending money market funds being used. You saw interbank money market funds being used, kind of how bills were the system. And this was lasting for a while. I mean, uh, it wasn't always called Eurodollar exactly, and there are times when it was more heavily on interbank lending. There are times when it was bank to bank domestic lending in the United States, or sometimes corporate lending heavy, but you saw that was the primary driver of what we considered the U.S. funding rate for a while. So if you were, for instance, uh, a Treasury futures trader and you wanted to trade a calendar, let's say you wanted to trade a ZN calendar, but the year is 2003, it wouldn't actually be SOFR, quote unquote, which would be influencing the financing aspect of that calendar, but it would be the Eurodollar rates. It used to be the GE complex on the mercantile exchange. If you have a brokerage, you can even look up GE. They haven't delisted it on some. You see GE, I believe M23, June of 2023 was like the last contract before SOFR took over at spot, but you saw the Eurodollar was the way the dollar repo was quoted. Now, what was the main difference between Eurodollar and SOFR? One of the biggest ones is credit was explicitly a factor within the Eurodollar system. So, unlike the dollar, where we talk about implied credit worthiness within the US government, but it's more supposed to be this risk free rate, uh, the Eurodollar actually had credit implied into it. Defaults, the credit worthiness of banks, the credit worthiness of corporations were all implied within the Eurodollar complex. And when things transition to SOFR, part of the big reasons for it is if you research the global financial crisis, some of those money market funds, even the ones that didn't break the buck, one, I forgot the name, I apologize, but it went from $1 to 97 cents. And for a money market fund, that is a very significant move. And ultimately what you saw after the global financial crisis is less confidence in this decentralized international bank and corporate lending and interbank lending based repo system. And with it was a combination of events. You had the zero interest rate policy by the Fed. You had a more nationalizing attitude towards repo from the U.S. government, and then ultimately you had the money market had I believe the prime money markets got a floating net asset value, and essentially that structurally shifted liquidity into collateral with short-term government debt within the United States. And that's how the SOFR complex won. It wasn't a transition, right? So if you're studying the history, there's no one point where we had SOFR or we had Eurodollar. Instead, you saw rule change after rule change, different ways the Federal Reserve handled repo markets, and different ways the U.S. government debt was even viewed, with the more issuance of debt even helped transition. And ultimately, by 2026, we can confidently say the dollar is our dollar repo rate is SOFR. Now, that wasn't always the case, but that's how it is now. And the point I want to make is the transmission of politics into SOFR. And this isn't necessarily I'm claiming there's a good or bad side to here, but looking in retrospect, looking at the rule changes, there is definitely a government interest within the United States to collateralize repo on the dollar to government debt. And this does essentially a few things. The first thing it does is it creates a constant private purchasing of US debts. And now uh, private banks are doing something similar to how the Fed creates currency with purchasing of the debt. So it creates this standardization of what we consider rates on the dollar to be. The second thing it does is it ties finance more into the American project. So uh, finance takes more of an interest in the US government and likewise, and this creates a mutual system where uh, stuff like the bailouts of 2008 may not need to be as extreme when the US government debt already goes straight to the balance sheets and some other collateral laws and legislation or Fed policy can take place without such a abrupt need to just intervene in the system. And the final point, which is interesting, is it created a kind of secondhand effect where internationally there were foreign exchange transactions to purchase U.S. debt. So when somebody did a GBP to USD, a Euro USD, a JPY to USD transaction, and they funded the dollar or vice versa, they were inherently tied to the treasuries market now. And this made the USD ecosystem directly and explicitly connected to the Forex markets, which for a policy of like national interest, defense, and geopolitics, this gave the United States government, which exists within a heavily private ecosystem, it gave it a unique, almost central planning edge to intervene in Forex markets because from the kind of 70s up until the global financial crisis, even though the GFC was mortgage and lending based collapse, you saw a lot of the biggest shocks within that period were Forex shocks, actually led a currency led shock. And this was another thing that the government and I think a lot of the people that advocated for SOFR called correctly. They called that yeah, the GFC was bad, but if we don't have a way to directly intervene with a potential Forex shock, this could be civilizational, especially with its ties to the repo market. Now, because of that, you had a situation where private banks and the U.S. government almost had a mutual agreement that the SOFR system would work. But will this system last? I have cases for both. The case for why it could last is that Forex insurance. I mean, the way the government can more directly intervene with foreign exchange markets, that is highly essential. Um, the ability to have risk-free repo, although there is still a credit, even in the formula of when U.S. T-bills are used, there's still a credit aspect in the quant math that's used, even if it's called implied credit. But to have a quote unquote risk free system is a major aspect for holding it. And the third is just a homogeneous collateral. People do like the homogeneity that SOFR has brought to the repo markets, and understandably so. I mean, you don't have to go and audit those repo packages like you had to do with these private money market funds, especially when there was ties to Lehman debt back in '08, and some broke the buck. And that makes it really good. I mean, even when I go on my phone and I look at money market funds to invest in, if you go to Schwab, the SWVXX and the SNOXX, there's a difference, right? So when it's treasury obligations, it's really simple. You're just looking at actual bills and the repo around it, and that's your money market. So you're getting that, and then Schwab gets a little spread on that. Where when you look at SWVXX, I mean, I was looking at it about a few months ago. I saw Hong Kong debt, Singapore debt, Japan, a few interbank lendings, domestic bank-to-bank lending, and even though it's very secure, repo is extraordinarily secure. You would still have to audit it if you wanted to be more professional with it. And if you're an institution, you have that floating net asset value rule, which makes things incredibly complicated, especially with large orders and leveraged orders. But there's also a growing case against SOFR. And one of it is the reason, one of the points of being a proponent for it, which is homogeneous collateral, is actually a point against it. And the other points is if you look at the 2019 repo crisis, if you look at the tariff crisis of 2025 and the way SOFR behaved, if you look at just any other during that treasury sell-off from 22 to 24, we had a few repo spikes there as well. And what you had in that period is you still had implied credit worthiness, just like how there was credit worthiness in Eurodollar. You had homogenized collateral. So when the spreads on the bills and treasuries start to mess up, that impacts everyone. So there's not as much of a creative balance sheet management if you are a SOFR only team, whereas private credit repo and other systems that people also deploy in their balance sheet, you could do some more diversification. So that's one argument people have made against SOFR, is that homogenization of repo. The next one is de-dollarization, and this is a huge one. The other one isn't necessarily changing what the US repo rate is, but it's actually talking about a balance sheet more as a basket of different international repos. And this isn't novel. I mean, the yen is the global borrowing currency and has been for a very long time. But you're seeing the idea of Pax Americana and finance coming to an end, and some people talking about a world of multiple different nodes of agency and a balance sheet to reflect that. Not over investing in a single state or government project, but going out in time and thinking about what happens when the Eurozone has agency, Britain has agency, Australia has agency, even Japan. Some have talked, if you keep up with the headlines, as agency, and being homogenized in the dollar just simply won't reflect the real geopolitical moves in a world that's like that. And there's an advocacy that people can start front run that by creating a diversified currencies balance sheet. And the final argument, which is funny, is you don't need to make the argument because it's already happening. I mean, go to Fred, and if you look at the M1 and M2, and you look at interbanks and other things, you're going to see the return to private money market funds, prime money market, interbank lending is exploding, and it has been right after that UST sell-off around mid 2023. Private repo really started seeing a return after that sort of 7-year period, 2016 onward, where it was the SOFR dominance. And those people will argue, just as there was no forced shift to one system, maybe SOFR still exists, but it exists as a plurality within repo, less as this kind of dominant figure. And I kind of agree with that as well. SOFR didn't mean the end of other repo systems. It just meant that was the agreed straight spot. And already, I mean, their special repo survived the whole time. So if you're a hedge fund trader, you really don't care about the economists arguing about SOFR or Eurodollar because you're already playing with the existing repo you get on the market. And those guys would argue that the flows show we're already returning to more of a privatized, decentralized repo market. And you're just simply arguing over a vanity spot. And I would actually agree with that point as well. But what you're going to see, and I think the tension that's going to arise from this situation is how is the US government going to be able to intervene as heavily in the Forex market with the de-dollarization, arguments of what should even the domestic repo be? And I think that's going to be a question that some really big brand economists over the next few decades might have to start asking and start researching because it's going to be new times for the dollar. It's going to be new times for dollar repo. And is the US government prepared for it? I would argue they probably are more than people would expect. But does the US government know everything that's going to happen with the current shifts and flows? I don't know. And I think we're soon to find out. But at the end of the day, I would make the confident statement that SOFR is headed to being a plurality, even within domestic repo. And the sort of the way the Eurodollar system worked is gonna might start being more of how we even spot dollar within even the 2030s. Anyways, thanks for listening to the second episode of Fixed Income Meandering. I apologize that this doesn't really follow like a strict formula of point A to point B in models, but this is more of my qualitative opinion series on fixed income, on geopolitics, on macroeconomics, and kind of how all of that intersects. And I felt like this was an important topic because this is going to be a dominant narrative soon if the same repo and forex flows continue. Anyways, take care and have a great rest of y'all's day.